A very warm welcome to all the dear students in this video. I'm Professor Aagam Dalal from Judicial classes. Now, why this video today? First of all those students who are going to appear in the examination of September 2025 or January 2026. For you, which financial year is applicable? Financial year 24-25, relevant assessment year 25-26. But you all know that for you people, there were two budgets that were applicable. One was Finance Act 2024 number 1, which came on 1st February 2024, containing very small kind of amendments. And the main budget which was applicable to all of you is Finance Act 2024 number 2, that was presented on 23rd July 2024, containing n number of amendments. Now, during the syllabus itself, when the syllabus was going on, as a last chapter, we have studied amendment lecture. And all those amendments which came in that particular budget is already discussed. Now, that particular lecture I have also uploaded on JKSC YouTube channel as an amendment lecture, which contains approx 5 to 6 hours. But the things are not done up to now. There is one more amendment lecture, and this video is for that only. So to all September 25 or January 2026 CA final students, over and above the amendments which you have already done, over and above the things which are given in your ICI module applicable for your attempt, ICAI recently issued 2 new PDF which ICAI generally issue in all the attempt. One is your statutory updates for September 25 exam, and obviously same for January 26, which contains approximately 35 pages. And the second one is judicial update, that is the latest case laws. The 5 case laws are given, containing 12 pages. Now, what is there in the statutory updates? Whatever are the notifications, circular issued recently, which is applicable for your financial year, but not given in the ICI module. Those notifications, those circulars are given in this particular PDF. So this 35 pages plus this 12 pages, what I have tried to do over here, I have just converted all this in a very summarized manner, in some lucid language. And I have tried to cover this entire 2 PDF in this 8 pages. We are supposed to understand these amendments. We are supposed to understand the importance of that in your examination. And along with that, this summarized PDF is also there, which will be uploaded in this video description itself. And this is only you have to do. First of all, let us start with statutory updates. Chapter by chapter will go. I'll make sure that not a single minute of your is wasted, because the time is very precious. Exam is just nearby only. So we try to summarize these particular things in as much minimum time as I can, and exhaustive coverage will be there. The first chapter in which the amendments are there, obviously the chapter which cannot be there without amendment, TDS, TCS, advanced tax. Let us understand the very first amendment that came in this particular chapter. Now, you all know there is a section called ATLA. Now, what ATLA section says, if you are into SEZ or if you are into IFSC and you are doing some of the businesses over there, either a banking unit or any particular business which is there in IFSC, then section ATLA gives them 100% deduction of their profit. If you are into IFSC, International Financial Service Center, as of now GIFT City, and if you are doing any kind of business into IFSC, particularly in SEZ area of IFSC, then you will get ATLA deduction, which is 100% of your profit for 10 years. But 10 years out of 15 years. So from the year in which you commence your business, from that first 15 years, you have to pick up any continuous 10 years. And in that continuous 10 years, you will get deduction of ATLA. But now what happens is, the deduction is there after gross total income. But this IFSC is there in India. So whosoever will make the payment to any of the business which is there in this IFSC, they will deduct their TDS. But now what will happen? They will get 100% deduction out of their PGP income, and ultimately their total income will become 0. So their tax payable will become 0, but their TDS is deducted. And hence they have to now claim the refund of the same. So their working capital is getting blocked. Now, Section is there 197A, lower TDS certificate or no TDS certificate, 15G, 15H form you have to file. This 15G, 15H is applicable for very few kind of sections. Now, and mainly applicable to residents. But now, income tax, that is CBDT, has given a notification that any payer paying certain income to certain businesses which are operating themselves into IFSC, if that pay is furnishing this declaration into 15G 15H form, payer will not deduct the TDS for this 10 years out of 15 years. So this 15G 15H form is not applicable for every year. It is only applicable for those years in which this IFSC unit is following section 80 LA. That payer will verify the statement, and if payer find it genuine, then they will not deduct the TDS, so working capital is not getting blocked. This 15G 15H benefit is not extended to IFSC unit lifetime. It is only extended for 10 years for which this unit is following 80 LA section. So see what I have written, notification number 28/2024, section 197A, that is no TDS certificate, read with section 80 LA, that is deduction section. No TDS is to be deducted if the payment made by any payer to below mentioned pay, which is a unit of IFSC, for the specified purpose. Condition is, payee has to furnish a statement cum declaration to the payer for the details of previous year out of 10 consecutive years opted for 80 LA. Payer will verify statement for every year out of this 10 years. So the statement which is given is not for 10 years. It is not omnibus statement. You have to give for every year. Every year payee will furnish the statement to the payer. Payer will verify that whether it is from this 10 years or not. If it is 11th year statement, then definitely payer will not accept it. Payer will only accept it if it belongs to 10 years. And after receipt of such statement, payer will not deduct the TDS. Now, who can give this 15G 15H declaration, for which kind of income and for which section this will be accepted? A summarized table is presented over here. If you are a banking unit in IFSC, all the pay which are mentioned over here has to be in IFSC, then only this notification is applicable. You are a banking unit. You are receiving interest income on external commercial borrowing or any kind of loan. Your TDS was supposed to be deducted under 195, but if this bank will give 15 GH certificate, TDS will not be deducted. But sir, no TDS to be deducted if the interest is payable to a bank, but that exception is given under 194A, not under 195. What if that banking unit is a non-resident? You must have deducted TDS under 195 because 195 is not giving you the exception of banking unit, and that's why the TDS of bank also would have been deducted if this kind of certificate is not given. Second, if this banking unit is receiving any kind of professional fee, under 194J, 15 GH will be given. Referral fee, commission, brokerage for 194H TDS, 15 GH will be given. Mainly 15G. Okay. Then if you are IFSC insurance company and you are getting any kind of insurance commission, your TDS would have been deducted under 194D, but on 15G statement which you will give, TDS will not be deducted. You are a finance company or any unit of such finance company, you are getting again interest income, dividend income, commission income. Under various section, your TDS will not be deducted. You are a fund management company receiving professional fee, again your TDS will not be deducted. You are a broker dealer getting dividend, investment advisor getting investment advisory fees. You are a registered distributor, you are getting your distribution fee or commission. You are a custodian, you are getting custodian fee or professional fees. Credit rating agency, you are getting your respected fees. Investment banker getting any kind of banking fees. Debenture trustee getting trusteeship fees. International trade finance service, you are getting your commission fees. Fintech entity, technical fee, professional fee or commission. So if this particular pays which are operating in IFSC receiving this kind of income, then for the third column sections they can give 15G form and their TDS will not be deducted. For examination, this notification is not that important, but yes, Definitely, if they will not ask you from anything from this table, at least they can ask you for this. They can merge this particular notification with ATLA in a case study form, that a unit is there in IFSC, and thinking about their income tax purpose and getting that TDS will also be deducted. Then what can be the advice that you can give? So first of all, the advice will be take ATLA deduction. Second advice will be give this statement cum declaration, because this notification is giving that option. So yes, this kind of thing can be asked. Second amendment. Now one thing was already there. 197A, again no TDS certificate. Subsection is 1D. 197A subsection 1D, which said that if you are an offshore banking unit, that is a banking unit of a foreign bank mainly operating in SEZ area, if you are an offshore banking unit and you are paying any kind of interest either to a non-resident or to any RBNOR, that is resident but not ordinary resident, for any deposit taken or any loan taken on or after 1st April 2005. So if you are an offshore banking unit, you have taken the FD or you have taken a loan from NR or RBNOR on or after 1st April 2005, whenever you will pay the interest, TDS will never be deducted. That open exemption were there in the case of TDS. Now the same kind of exemption is given if the interest is paid by IFSC banking unit. So earlier it was for offshore banking unit. Now IFSC banking unit will also not deduct any kind of TDS if the money is borrowed or deposit is taken from a non-resident or RBNOR on or after 1st April 2005. So the same kind of exemption is given to IFSC banking unit, that they will not deduct the TDS of that NR or RBNOR. I'm repeating one thing. This payer will not deduct TDS of this payee, that is NR or RBNOR. If a IFSC banking unit is giving something to R&OR, TDS will definitely be deducted. Third point is with regards to section 194N, and that is a TDS on cash withdrawal. If you withdraw from any bank account more than 1 crore, more than 3 crore if you are a cooperative society, more than 20 lakh if last 3 years financial ITRs are not filed, then TDS at the rate of 2%, TDS at the rate of somewhere 5% will be deducted. But no TDS under 194N is to be deducted if the cash is withdrawn by ATM operator, a trader or agent which is in APMC, that is Agricultural Product Market Committee, or the person who is withdrawing the cash is government, NBFC bank, ya to post office, or any other person as notified by government. So here 194N is giving a power to CBDT. They can exempt any person of whom TDS will not be deducted even if they withdraw n number of cash. Now CBDT has notified certain person over here whose TDS will not be deducted even though they are withdrawing lots so many cash. Foreign representations duly approved by Ministry of External Affairs, including who are exempted now, these people. Diplomatic missions, agencies of the UN, international organizations, consulates and offices of honorary consuls which are exempt from paying taxes in India as per the Diplomatic Relation Vienna Convention Act 1972 and the United Nations Privileges and Immunities Act 1947. So mainly all the international organizations or branches of United Nations are exempted. Their TDS will not be deducted even if they withdraw the cash from Indian bank account. Okay, this is okay for the exam, not that important. Fourth one. It is related to section 197A subsection 1F. Again 197A. Subsection 1F is giving a power to central government that they can bring any notification by which they can exempt certain entities from any kind of TDS section. So if any notification will be brought under this section and any name of the organization will be given, any class will be given under any section, their TDS will not be deducted, because it might be possible that the organizations which are notified under this particular subsections are fully exempted from income tax. Then why to deduct their TDS? Central government has notified certain 3 to 4 people, 3 to 4 organization whose TDS will not be deducted under any section. Number 1, Credit Guarantee Fund Trust for micro and small enterprises as referred in section 10 clause 46B. So this 10 clause 46B give the exemption to this trust, 100% exemption. Then why to deduct their TDS? Second, National Credit Guarantee Trustee Company Limited, referred in again the same section because their income is also exempt. So again, no need to deduct the TDS. A credit guarantee fund established and wholly financed by central government and managed by National Credit Guarantee Trustee Limited. That is the same company which is mentioned in B point. So if it maintain any credit guarantee fund, then also their TDS will also not be deducted. So all these three exemption is with regards to 10 clause 46B because their income is exempt. So TDS also not to be deducted. But the fourth exemption is certain something unique, and this can be asked in the exam. Okay, first of all, what is TDS under 194Q? If I'm a particular person who is buying the goods, I am a buyer who is buying the goods more than 50 lakh from a particular seller. And as a buyer, my last year turnover was more than 10 crore. I'm supposed to deduct TDS of the seller at the rate of 0.1% over and above 50 lakh. But what if that seller is in IFSC and taking the deduction of 80 LA section for 10 years? Then I will deduct the TDS, but ultimately that seller don't need to pay any kind of tax. And that's why once again government is exempting those seller that TDS will not be deducted if a seller is there in IFSC taking the benefit of section 80 LA. And the benefit will be given under two things. One, TDS under 194Q. Second, TCS under 206C subsection 1H. First, let us discuss about 194Q. No TDS to be deducted under 194Q by the buyer from the seller if the seller is in IFSC and if that seller is furnishing a statement cum declaration of 197A 15G for opting 80 LA. It is to be furnished for every such year out of this 10 years. Acha, what is 206C subsection 1H? I am a seller whose last year turnover is more than 10 crore. I am selling the goods to a particular buyer more than 50 lakh during the financial year. I will collect TCS 0.1% over and above 50 lakh. But what if that buyer is in IFSC? I will collect the TCS. No tax is payable by that buyer because that buyer is taking 80 LA deduction. So TCS is to be refunded to the buyer ultimately by the government. Then there is no point of collecting TCS. And hence the similar kind of exemption. Same benefit given for the TCS section also. But now buyer should be into IFSC. And even he has to furnish the declaration also. So this particular notification is for 194Q and 206C subsection 1H. Now, something very important. And actually the main purpose why I came out with this video. One entire new topic is added into your syllabus. The topic was there. The topic was there in Income Tax Act since years and years. But it was not there in the syllabus. If you check out your module, there is a chapter called Provisions to Counteract Unethical Tax Practices. And there is nothing but penalty, offense, and Black Money Act. These three things were there in this particular chapter. One thing was offense. And there is a section also in your syllabus, section 279, that any offense under Income Tax Act is a compoundable offense. Any offense under Income Tax Act is a compoundable offense, means compounding can be done. What is the meaning of compounding? Very simple meaning. If you refer section 37 subsection 1 and that explanation 3, that also give a reference of the word compounding. Explanation 3 of 37 subsection 1 says that any compounding fee which is paid is disallowed under PGBP. 279 says any offense under Income Tax Act is compoundable. What is the exact meaning of compoundable? I have committed a crime which is the offense under Income Tax Act. And under various sections of Income Tax Act, there are so many different punishments that is written. somewhere the imprisonment of 6 months, somewhere imprisonment of 1 year, somewhere imprisonment of 2 years, somewhere imprisonment of minimum 2 years, maximum 7 years, plus fine, etc. For not furnishing the return, not paying the tax to the government, for taking false entry, not cooperating to the government, not attending the summons, etc. etc. What if I have committed the offense? Prosecution is to be started against me, that the court trial will start, or it has already been started. And I'm ready to accept that, okay, I have done this offense. I don't want to go to jail. I can directly tell to income tax authority. I can just give an application to income tax authority that I am accepting my offense. I'm ready to pay the charges that you say, but please don't give me imprisonment. So instead of taking imprisonment, I will pay monetary charges to save myself from going to the jail. Now, this thing is called as compounding. When compounding can be done, to whom this application is to be done, how many applications can be done if I have done, n number of offenses, how many charges I have to pay, in what time this compounding process will get completed. For all this, there was a guideline of CBDT, but that guideline was not there in your syllabus. Now, CBDT has came out with one more guideline out of the budget of 23rd July, when Nirmala madam has said that we'll, ease the compounding process. By looking at that, CBDT came out with the revised guideline for compounding, which is applicable from 17th October 2024. One more date which you need to remember, 17th October 2024. And this revised guideline, ICAI has brought into your syllabus also from September 25 and onwards. So yes, we need to understand the entire guideline of compounding now. But very easy thing, so many pages, out of this 35 pages belong to this one topic called compounding. I have tried to summarize, but the language is not compromised rather, because very important topic for the exam. With two examples, these examples are not made by me, it is given in statutory update. I have just copied it over here so that everything remain in one PDF. So this example are not of mine. I'll not take the wrong credit out, obviously. Now, let us understand what is exactly compounding and how it works. As I said, section 279 subsection 2, any offense may either before or after its institution of the proceedings be compounded. So yes, compounding can be done before also. Prosecution has not started, but you know that it will start. So rather, just go prior to that to the authority and accept the crime, accept the offense, and tell them, please take the charges and relieve me. Second case, prosecution has already been started. Now you are going to the authority and you are saying that, okay, I accept my offense. I'm ready to pay the charges. Please relieve me from this prosecution. So it may be before or it may be even after. Be compounded by whom? Principal Chief Commissioner or Chief Commissioner or Principal Director General or Director General of Income Tax. These four authorities are empowered to give the compounding. CBDT can issue the guidelines for this. Revised guideline is issued on 17th March 25, applicable from 17th October 24. So okay, released on 17th March 25. That's why it was not there in May 25 syllabus. It is there from September 25 syllabus. Because your exam and prior to that 6 month, whatever circular notification comes, it is there in your syllabus. So it was not there in May, it is there from September 25. What is compounding? It is a mechanism whereby the defaulter is deprived of major legal consequences by affording him an opportunity to pay certain sum of money to escape the prosecution. As I said, monetize. All the offences of Income Tax Act is compoundable. All the offences. Now, this revised guideline is effective from 17th October 24, applies to all the compounding application filed after this date. So, whosoever file any new application on or after this date, this new guideline will be applicable. Even those applications which are filed prior to this date but pending, it not yet disposed of, will also be taken care of as per the new guideline. For that, you don't need to file any fresh application or no need to pay the fees again. Your old application will be continue in as per this new guideline. In case of application under earlier guidelines were rejected solely on the account of curable defect. So we'll understand that whenever you apply for the compounding, your tax payable has to be completely paid. First of all, you have to mention properly the years, the sections in which you need compounding. And if any mistake is there, authority can reject your application. Now, what if, as per the earlier guideline, your application was rejected because of this curable defect, clerical errors? Now, as per the new guideline, you can again make the application. It will be counted as a fresh application, as a new application, and they can start compounding process. Fresh application may also be filed for this curable defect. But what if, as per the old guideline, you have applied for the compounding prior to 17th October? Authority has found the application proper, but authority don't want to give you compounding. It's totally on the part of authority whether they will give you the compounding or not. So what if your crime was such a serious nature crime that authority has rejected your application by saying that you have a culprit mind and hence will not give you compounding facility, you have to go into jail? Now, as per revised guideline, you cannot do the fresh application for the same offense, because your application in the earlier guideline was rejected based on the merits, not based on the clerical errors. So application rejected in the past on the merits by competent authority shall not be reconsidered under this revised guideline. So if it was due to clerical errors, yes, you can do the fresh application for the same offense. But if it was due to some merits it was rejected, now you cannot do the same application again. Offenses may be considered for compounding, maybe, not compulsory, may be considered for compounding if all the conditions are satisfied. First, to whom you have to do the application? To the competent authority, principal chief commissioner, principal director general, or director general. Application may be for 1 year, and if deductor, so for example, offense is done by any TDS deductor. So the crime or the offense is related to a quarter. So this application can be one financial year offense, can be one quarter offense. What if I'm a person who has committed offense for more than 1 year? What if I'm a person who has committed offenses under various sections into 1 year? What if I'm a TDS deductor, committed the offense for so many quarters? Then I can file only one single application for all such offenses considering more than one offense, covering more than one financial year, covering more than one quarter. This will be called as consolidated compounding application. So rather than doing different application, you know that you have committed 3 to 4 crime, 3 to 4 offense. You can do only one single application. And the procedure will become simple, but that will be called as consolidated compounding application. The charges will be higher because more than one offense is there, so fees will be higher. If there are more than one rejected application under the previous guideline due to that clerical error, then for all those clerical error rejected guidelines or rejected applications, now as per the revised guideline, you can do a fresh application. That also you can do consolidated. That is also possible. So for example, in earlier guidelines, I have done 3 or let's say 4 application for 4 different offenses. One out of that was rejected due to merits. There was some base for rejecting this, proper base. I cannot do the fresh application. But the 3 of the other offenses out of the 4 offense for which compounding application was done, now those were rejected due to some clerical error. So my tax was pending and all that stuff. Now I'm going to rectify all the errors, and now in the new guideline I want to reapply for compounding. Yes, I can do that. I can also file one single application for all these 3 offense combinedly, and that will be again considered as consolidated compounding application. So yes, I can do single application also for more than one offense, more than 1 year, more than one quarter. I can combine them all and make one application also. Applicant can withdraw the previous application, can file a new single application or consolidated application after withdrawal of the earlier applications. However, such new application shall be treated as a subsequent application and higher compounding rate shall be applicable, which is discussed later on. After some time, we will understand that if I have committed one offense, let's say under section 276C, my offense is of section 276C. I have done one compounding application. In another financial year, I have committed the same offense. So I have done one more compounding application for the same section for different financial year. It is my second application for the same offense. Whatever will the compounding charges, it will get higher. It will be now 1.2 times. So let's say my compounding charges decided is 50,000. In the first application of 276C compounding, 50,000 has to be paid. When I'm making the second application, now I have to pay 50,000 into 1.2. That much fees will be paid. If for the same section I'm making any third application, it will be 1.4. So like this, in multiplications, I have to pay the compounding charges. We'll understand that. So now what they are saying, if I have done a compounding application, either single or consolidated, later on I change my mind. Somebody advised me that why you are accepting your offense. So basically I am withdrawing my application. I can withdraw the same. But now once again I want to go for compounding because I have again changed my mind. I can again apply for compounding, but that will not be counted as first application. That will be counted as a subsequent application, and higher compounding charges has to be paid. So withdrawal is also counted as one application. Okay, there is no limitation on the number of times a person can file compounding application. As I said, if one offense I have committed for 15 years, for 15 times I can apply for compounding. However, competent authority may reject the application filed by you on the ground of habitual offender. That one offense you are doing for 15 years, you are really of culprit mind person, and hence compounding will not be granted. This competent authority can definitely say, because the power to approve or reject is with that authority. What is the time limit to file this compounding? It is to be filed first of all suo moto. Nobody can give you the compulsion at any time after the offense is committed. You cannot go before that, okay, I am going to commit this offense and hence compounding. No. First you commit the offense. Once you commit the offense, then you go suo moto to the authority that, okay, I have done this offense. I accept this because I know in the future you will come to me. So better I am coming to you and I am saying that I have done this offense. Kindly accept this application and give me the compounding. Or whether it came to the knowledge of department or not. Even though department is not knowing that you have done the offense, but if you know that for sure I will be caught up later on, then yes, you can directly go to the authority and say that I have done this offense. This is the information I want to apply for compounding. Even application can be done after the launch of prosecution proceeding also. Let's say you have done the offense. Now you are not going to the authority. Authority came up to you and saying that you have done this offense. You say, you are not saying anything or you replied something, whatever. Prosecution proceeding has been started. In the court, complaint has been filed against you. Then yes, even then after also you can file this compounding application. How much fees you have to pay? A non-refundable application fee of 25,000. Refund will never be given. Even though your application is rejected, this fees will be there with the income tax department only. This is the non-refundable 25,000 rupees of fees. And if you file a consolidated application, then 50,000 will be the fees. This fee can be adjusted against total compounding charges decided by the competent authority. Let's say I have done a single application of compounding containing one offense. Fees 25,000. After the entire process, competent authority says that you have to pay a compounding charges of total 1 lakh. 25,000 I have already paid. How much I have to pay now? 75,000. This adjustment only against the charges payable in the same application. Cross application adjustment is not allowed. What I mean by this, for example, I have done let's say two applications, different offense. For one application, I have paid 25,000. For the second application also, I have paid 25,000. Now this first application is accepted and government is saying that you have to pay 75,000 rupees of total compounding charges. And this second application is, let's say, rejected. So this 25,000 also cannot be set off against this 75,000. Against this 75,000, I can only adjust that 25,000 which is paid as a fee of that application. Cross application adjustment cannot be done even though it belongs to the same person. This 25,000 is a bad debt for me. It will totally go to income tax department. And now for the first application, I have to pay how much? 50,000 rupees because 25,000 I have already paid. Before making compounding application, all the outstanding tax, interest, penalty to be paid. This is the first condition that you can go for compounding only when, see, you are accepting your crime. So first you pay all the tax, interest and penalties that are due. And then you pay some extra monetary charges so that imprisonment is not applicable. So first all that tax, interest, penalty has to be paid. Now what if I have done the application of compounding before making the payment? And now government came to know on scrutinizing the application that though I have done the compounding application, my outstanding tax for the relevant year, for the relevant crime is still payable. It is still outstanding. Then they will give me the opportunity to pay the tax in 30 days. It can be extended, but maximum 3 months. If I'm not paying in that extended time also, my application of compounding will be rejected and prosecution will be started. If on the verification department found pending, that is still outstanding, then time of 30 days to 3 months will be given for the payment, and after payment only application will be considered valid. Applicant will undertake to pay the compounding charges. Before making the application, you have to file an undertaking that okay, I take an oath that whatever will be the compounding charges, I will pay the same. It should not happen that entire proceeding is done, competent authorities telling you that please pay compounding charges of 2 lakh, and now you are saying no, this is too much, I don't want to pay the same. No, you have to give the undertaking first, then only competent authority will give their time to this application. Second, what if on one hand you are accepting this offense and you are saying that I want to do compounding, and on the other hand you are also going for appeal against the income tax authority order that no, I have not done this offense. How that can be doglapan, Then on a side you can say that yes, I am accepting my offense. On a second side you are going for appeal. Two things cannot be there simultaneously. And hence applicant will also undertake to withdraw the appeal related to same offense. And if appeal is filed containing more than one ground, withdrawal of that ground has to be done which is related to the offense for which compounding application is done. So let's say I have gone to the appeal related to 3 sections. Income tax has charged me for 3 sections. I have done appeal for that 3 sections. But now out of those 3 sections, only one offense I want to accept. And for that I'm going for compounding. My appeal will continue. Totally it will not be withdrawn. But now the appeal will continue with regards to balance 2 grounds of appeal. That one ground which is related to compounding will be withdrawn. Here you have to just give the undertaking. Withdrawal actually not to be done. So for example, you are going for compounding. Along with that, you undertake that if the authority is accepting this application and I am paying compounding charges, then I will withdraw this appeal. What will happen if you withdraw the appeal also? And compounding application is also rejected. In that case, the problem will be there. And that's why what government is saying, as of now, you just need to give undertaking. Actual withdrawal is not to be done. If any curable defect in the application, like non-payment of tax, interest, penalty, etc., then defect to be corrected in 1 month of the intimation. So application will be scrutinized by the authority. They will not directly reject. They will tell you that there is some curable defect. You have not filed the proper form. You have not prepared the proper structure. Section numbers are not written correctly, etc., etc. And within that intimation, in 1 month, you have to correct those defects. And if you fail to do so, application will be rejected. It will be returned. And now you have to file a fresh application. But that fresh application will be counted as a subsequent application. So, for higher charges will be applicable, because your first application was rejected. A competent authority can compound below offences only after the approval of chairman of CBDT. So there are certain offences of which before giving the compounding, chairman of CBDT's approval is required. Some 4 serious nature crime. If it is conviction of imprisonment of 2 years or more. So below 2 years, that competent authority themselves can give the compounding. If it belongs 2 years or more, CBDT chairman approval is required. Offense of anti-national or terrorist activity. Offense directly related to black money, undisclosed foreign income and asset, and imposition of Tax Act 2015 or prohibition of Benami Properties Act. And last, offense of 275A or 275B, which is related to search. For this 4 kind of offense, chairman of CBDT's approval will be required. Now, what is the exact compounding process? Up to now, we studied that, okay, what are all are the points which you have to keep in mind. That application has to be done. All the curable defect, 1 month time will be given. Either it will be accepted or it will be rejected. If it is rejected, new application has to be filed. That will be called as subsequent application and higher charges will be applicable. then we saw that okay, if you have already done an application under the old provision, now as per the new provision, once again you can do the application. If it was rejected other than based on merits, that is also counted as a second application and higher charges will be applicable. Now what is the process? First, you have to file an application to the authority. Authority will ask the report from AO, assistant director or deputy director about your case, because they don't know the case properly. Acceptance or rejection order to be passed within 2 months from end of the month in receipt of application. So within 2 months from end of the month, either they will accept or they will reject. If they are rejecting, obviously they will give you opportunity of being heard. Whatever charges are decided, applicant has to pay within 1 month from end of month of intimation. Within 1 month, you have to pay that compounding charges. This 1 month time period can be extended up to 6 months. But if the higher authority, that is the competent authority, wants to give you extension more than 6 months up to 12 months, that extension can be given with the prior approval of Principal Chief Commissioner. If the competent authority wants to give you the extension of payment for more than 12 months up to 24 months, approval of Chairman of CBDT is required. In no case, extension can be given more than 24 months, maximum 24 months. More than 24 month extension never possible. Remember that. One good news is, in case of extension, interest is not to be charged. So you don't need to pay any kind of interest even though extension is given. If charges are not paid in the time allowed, the application will be rejected, prosecution proceedings will be initiated. And the charges, if paid within the time, compounding order will be passed within 1 month from end of month of the payment, and the prosecution proceedings will be dropped. Now the question is, how much compounding charges are to be paid, and this is the most important topic according to me for your examination. So far as compounding charges are concerned, the charges will be decided by the authority. So whatever they will decide, that will be final. But any application, if you are filing after the first application, is to be counted as subsequent application, that is second, third, fourth and so on. So for example, I have done an offense under, let's say, section 276C for first time. I have done a compounding application. Either it may have been accepted or it may have been rejected, whatever. Now for the same offense in some another financial year, I'm again doing compounding application for the same offense. It will be counted as subsequent application and the proportionately higher charges has to be paid. That is what the third point is. If a person applied for compounding of an offense, the type of which was applied earlier, then compounding charges for the subsequent offense shall be 1.2 times if it is the second time application, 1.4 times if it is third time, 1.6 time if it is fourth time application, and it will continue so on. So if it is for fifth time, it will be 1.8 times, like that. If it is fifth time, sixth time, generally competent authority will not grant you the compounding by saying that you are a habitual offender. If a subsequent application includes any offense, the type of which had not been disclosed in any of the earlier application, the compounding charges of the said offense shall be computed only as per the charges given in these guidelines. So various guidelines only tell us that what are the compounding charges that competent authority will decide, but that is not there given in the particular syllabus. So you don't need to remember the exact charges of each and every offense. But let's say today you are making an application related to an offense, and for that offense you have not done any compounding application earlier. Earlier you have done the compounding application, but it was some different section. Now what application you are doing is related to some another section. It will be counted as the first application and the normal charges will apply. It will not be proportionately higher. Where the compounding application has been filed in accordance with prior guideline, either pending on 17th October 24 or rejected or have been compounded, all such application filed prior to issuance of this revised guideline shall together be considered as the first compounding application. So let's say 17th October 2024, when this revised guideline were made applicable, prior to that, I have done 3 compounding application. 2 applications were regarding section 275A offense and 1 application was regarding section 275B. Either it may have been accepted or it may have been rejected or it may have been pending on 17th October. Now let's say on or after 17th October, I have done 2 more applications. One application again 275A related to some another financial year. Second application of 275B related to some another financial year. Now this both will be counted as the second application. But sir, 275A, this is the third application, na? Because earlier you have done two applications of 275A prior to 17th October. That's what this point is saying. Whatever application you have done prior to 17th October for any offense, even though once, even though twice, even though thrice, even though fourth times, all those will be counted as one. And now from 17th October, whatever application you will do for the same offense, it will be counted as the second one. So here, even though earlier I have done two application, but it is prior to 17th October, this will be combinedly called as one. And on or after 17th October, whatever I'm making an application, it will be called as second. So 1.2 times I have to pay the charges. For 275B, I have done one application earlier, either accepted or rejected. It is counted as one. On or after 17th October 24, again I am doing the application for 275B. It will be counted as the second application and 1.2 times the charges will be paid. So summary, if any application accepted or rejected pending up to 17th October 24, it all will be counted as one application and the normal charges will apply. Any new application or after 17th October 24 for the same offense will be counted as a second application, and for that 1.2 times the charges, and if it is the third application, 1.4 times the charges will apply. Now here I have given you the example. Again, example is given by ICAI, so please consider it important for the exam. This example is not drafted by me. It is the same example which is given in this statutory update PDF. But just because you don't need to refer this PDF, all the things I have combined in this one particular my summary notes itself. So yes, this is the same example that they have given over here. See, and this example just I have copied over here. Let us understand one by one this example and the scenarios. This entire example belongs to the same person who is doing so many compounding application. The first application this person has done on 15 January 2021, which is compounded, approved, related to section 276B for financial year 2012-13. So obviously it is prior to 17th October 24, and hence we are not supposed to discuss much about that. Second application is done on 17th October 2020, which is also compounded, but it is related to section 276C of financial year 18-19. Again, prior to 17th October 24, we are not supposed to see anything else. Third application is on 18th August 2023, but it was rejected. Again, it was of 276B. So actually, if you see, it is the second application of 276B for some different year. But both this application is prior to 17th October 24. So both combinedly, what will say for 276B, one application was done earlier. For 276C also, up to now there is one application which was done. On 17th September 24, again prior to 17th October 24, you have done one application on 276D which is still pending. So now for this application, you are not supposed to do any new application. The same application will continue as per the revised guideline, and this will be counted as the first application only because no new application is filed. So normal charges will apply on this. On 1st November 24, you have done a single application for section 276B, which was rejected earlier. But see, even though it was rejected earlier, this is counted as a new application. Up to 17th October, regarding to 276B, you have done two applications, which both to be counted as one. And now you are doing this on or after 17th October 24 for the same offense. This is counted as a second compounding application. Whatever will be the charges, you have to pay 1.2 times. Are you understanding this? On 18th December, again you are doing a consolidation application. In that, three offenses are considered. That's why it is called as consolidated. First one is 276B again for some different year 17-18. Now see, up to 17th October, two applications were done, which is counted as one. On or after 17th October, one more application was done that we called second. And this is once again you are doing for 276B. So this is considered as third. And whatever will be the charges, you have to pay 1.4 times. Acha, you are doing one more application in this. One more offense is considered in this consolidated application 276C. Can I say up to 17th October? With regards to 276C, one application was done. And now on or after 17th October, again you are doing the application for the same section. This will be counted as second and you have to pay the charges which will be 1.2 times. And in this consolidated, you are doing one more application of 275A. But as you can see earlier, there is no application containing the same section. So this will be counted as the first application and the normal charges will get applied. Are you understanding this? So though this is a compounding application, consolidated application, all the offenses has to be treated separately and their charges will be decided separately. And whatever is done prior to 17th October, all to be counted as one. Are you understanding this? One more important point over here. If income tax has initiated prosecution complaint against you, so prosecution process is started. And now you realize that I have to go for compounding. You can go for it. But please go within 12 months from end of the month in which that process is started. If you are going for compounding application beyond 12 months from the end of the month in which prosecution complaint is filed, whatever is the charges given under this guideline, you have to pay more 50% of the same. So for example, Income Tax Department has started prosecution process against me on 15th December 2024. Then what is the end of the month? 31st December 24. Within 12 months, 31st December 25, if I am going for compounding of the same, I have to pay the normal charges. If on or after 31st December 25, I am going for the compounding, I have to pay the compounding charges plus 50%. The charges will be increased by 50%. Now, if let's say this is the second application, then first of all, your charges will get increased by 1.2 times. So total you have to pay 1.2 times and of that you have to pay 50% now more if you are filing this application after 12 months. So first you decide what are the normal charges, either normal or 1.2 times or 1.4 times depending on the time of that application. And if you are filing it after 12 months from prosecution started, then that charges will be increased by 50%. See, if the application is made beyond 12 months from end of the month in which the prosecution complaint is filed, the compounding charges shall be increased by 50% of the amount calculated above. So first you have to do normal or 1.2 or 1.4 or 1.6 etc. Of that you have to add 50%. So it will be too much. See, there is one more example that statutory update has given over here. In the same PDF, one more example is given, which I have reproduced. There are two different scenario. Let's assume assessee had made TDS default of rupees 10 lakh for 3 months during 1920. Prosecution has been launched on 1st April 22 under section 276B. Sorry. Normal compounding charges in the case, suppose 45,000 as per the guideline. Now, let's assume scenario 1. No earlier application is rejected. This is the first application. Case 1. Let us assume that the compounding application is done on 12th October 22, which is still pending on 17th October 24. That's why we are discussing. See, prosecution has been started on 1st April 22. Compounding application is done on 12th October 22. Can I say it is within 12 months? So here you have to pay normal 45,000 charges. But what if over here, you would have directly done the application under the revised guideline on 31st October 24? Prosecution started on 1st April 22. Revised guidelines, you have done the application on 31st October 24, beyond 12 months. Then you have to pay 45,000 into 1.5 times, that is more 50%. Total you have to pay 67,500. Now let's assume that first application was rejected for the same offense under the earlier scheme. And now, see, let's say 1st April 22, prosecution started. Under the old scheme, under the old guideline, you have done the application for prosecution on 12th October 22, which was rejected. So no compounding charges were paid because application was rejected. On 31st October 24, now you are filing the second application under the revised guideline for the same offense. So here two things are happening. First, you are doing the second application for the same offense. Plus you are doing the application beyond 12 months. So indirectly, whatever is the charges, in my example 45,000, Of that you have to do 1.2 and plus you have to add 50%, that is multiply by 1.5. So indirectly you have to pay total 81,000 because this is the second application and beyond 12 months. So more 50% is to be paid. Are you understanding this? These two examples are very important for your examination to understand that how much charges are to be paid. The basic charge amount will always be given. You will be asked either normal or 1.2 or 1.4 or more 50% depending on the time of application. So that was all about compounding. Now, with regards to non-resident taxation, there are basically two amendments that you have to remember. On the budget issued on 23rd July 2024, one more presumptive taxation was brought. For a non-resident engaged into cruising ships, a non-resident having business or operation of cruise ship, a section is introduced 44 BBC that whatever is the total receipt of that directly you disclose 20%. No further PGBP sections applicable, no further inquiries will be done. 20% is the presumptive rate given in that section, which is already discussed in that amendment lecture. But in that, which ships are eligible? That at that time government has said as may be prescribed, will bring some conditions. All the ships cannot take this benefit. Only few non-resident having cruise ship business, fulfilling the conditions. Which conditions? Now they brought. Rule 6 GB. For 44 BBC, an assessee being a non-resident engaged in the business of operation of cruise ship has to operate the ship carrying capacity of more than 200 passenger or length of 75 meters or more. So either the capacity should be 200 plus or the size of that cruise should be 75 meters or more, and this should be completely for leisure and recreational purposes. Second condition, the ship should touch at least two seaport of India. For example, let's say Goa to Andaman, Mumbai to Goa, like this. Or same seaport of India twice. So let's say Goa to somewhere to Goa. So it should either touch two ports of India or it should touch one port two times, to and fro. Then only it will be eligible for this section. It should be primarily for carrying passengers, not for carrying the cargo. So goods should not be the main purpose of the ship. Passengers should be involved mainly. Operate such ship as per the procedure and guidelines issued by Ministry of Tourism and Ministry of Shipping. That is okay. These three conditions were more important. Then there is a section 285. If any person is having a liaison office of a non-resident in India, then that liaison office has to submit a statement to Income Tax Department that what activities it has done in the past financial year. So that Income Tax Department can understand what are the scale of activities that the non-resident is doing over here and whether any taxable income is earned or not. For that purpose, this non-resident having liaison office has to file a statement. Earlier, some different time limits were given for this statement. Then Income Tax Department on 23rd July amendment said that the new time limit will be prescribed, which has been prescribed now. Rule 114DA says that this statement will be furnished in form number 49C within 8 months from end of the financial year. So 31st March is obviously the end of the financial year, and you can count that 8 months will complete on 30th November. So basically 30th November 25 will be the due date for the financial year 24-25 and so on. So 8 months from end of the financial year, form number 49C is to be filed. Then the next chapter in which there is an amendment, transfer pricing, or we can say the last point of this statutory update, transfer pricing. So you know that any person who is doing specified domestic transaction or any international transaction with associated enterprises has to carry out the transaction at arm's length price. If it is not at arm's length price, then the necessary adjustments will be done. Now, what if you don't want any kind of dispute, any kind of litigation? The first option is assessee should go for APA, that is Advanced Pricing Agreement, wherein they will go to Income Tax Authority, they will disclose the terms of the contract and all the situations, and that both together will decide that what should be the arm's length price. and that will be accepted by assessee, that will be accepted by the department, and it will be applicable for 5 years, and even for prior rollback is also possible. The second point is safe harbor rule. What is safe harbor rules? Safe harbor, it says that if you are a assessee for whom income tax department has already brought some rules, a particular rate will be given that okay, if you are doing this particular business, you are covered by transfer pricing, disclose this much percentage profit. We'll assume that it is at arm's length price. See, advance pricing agreement is assessee to assessee. It is subject to a particular assessee. Case to case it will change. Safe harbor rules is like presumptive. That government will assume, you also assume that this much is your profit percentage. And further, no arm's length price adjustment will be done. No further deduction of PGBP applicable. No further disallowance will be applicable. It is purely presumptive only. But particular presumptive provisions for those who are covered by transfer pricing. Now, this is not subject to assessee. This is the overall percentage. Whosoever carry out that business, whosoever carry out that activity and covered by transfer pricing can opt for safe harbor rule. Safe harbor rule is not applicable. You assessee don't have an option to adopt safe harbor rule as and when he wants. He has to apply to income tax authority that I want to go for safe harbor. They will check that whether your business is covered by this or not. And if they satisfied that you are squarely covered by this particular business, they will give you the order that okay, you can go for safe harbor rules, and you disclose your income according to that. And then it will be deemed that now no further adjustment will be done. Income tax is also accepted. And that's why while writing any answer of transfer pricing, 2 notes you have to compulsory write. First, assessee has not adopted APA. Second, assessee has not gone for safe harbor rules. Then only now we are doing the actual adjustment. But safe harbor rules are not there in the syllabus as of now. But if you are a person who is covered by section 9, business connection in India, and because of that income taxable in India, then whatever is your income attributable to the operations in India, that much income is taxable in India. And that person also needs to carry out the adjustment of transfer pricing. Safe harbor rule is notified for that particular section. So if I have a business connection in India, through that my income is getting taxable in India, that proportionate income will get taxed in India, which is related to operations done in India. But if I don't want any kind of dispute, I have to accept a particular percentage what they are saying to me as my profit. And if I accept that, then it's done. Now, no further litigations will be done. So a particular safe harbor rule is notified over here. As per section 9, any business connection in India, so much income attributable to India will be taxed in India, and section 92 CB empowers the CBDT to bring safe harbor rules for this purpose. CBDT has inserted 10 TI, 10 TIA, 10 TIB, 10 TIC rule numbers. First of all, a very limited category is covered over here. Who is eligible assessee for this safe harbor rule? A foreign company engaged in the business of diamond mining and carrying business of selling the raw diamond in any notified special zone and exercise the option of safe harbor. But sir, in section 9 business connection, there was an exception that if foreign company is displaying uncut diamond in the special zone, then it is not a business connection in India. No income is taxable in India. Then why we are discussing safe harbor rule? Beta, that exemption is only when you display the uncut diamond. What if you are actually selling it? Then to income is taxable in India. Then this 92 CB empowers CBDT to bring safe harbor. So only display you are doing, not a business connection, but actually you are selling that raw diamond, and that in a notified special zone. Income is taxable in India. And if assessee wants, he can adopt safe harbor. Option is there. Compulsion is not there. Now, eligible gross receipt for which this safe harbor rule is applicable for all the income of that assessee? No. Only for that amount which is paid or payable or received by assessee on account of the sale of raw diamond. Any other income will be taxable as per the normal provision, and normal adjustment will be carried out. Only this particular sale income of raw diamond, not processed diamond, raw diamond, uncut, unfinished. Only the sale income of that diamond is subject to safe harbor. If assessee opt for safe harbor in any of the previous year and income is declared as per the rule, it will be accepted by IT authority unless rules are later on declared invalid. But what will be the PGBP income that you have to assume? 4% at least, either 4% or more than that of the gross receipt of such business. So you assume 4% is your income. Whatever is your sales of the raw diamond in the special zone of that 4%. But please remember, only foreign company who is selling raw diamond, that too in a notified special zone, is eligible for this. Of the sale, 4% will be the minimum PGBP income. If you accept this 4% by adopting safe harbor, no further deduction from section 30 to 38. All are assumed to be given. Even depreciation is also not to be given separately. WDV to be calculated as if depreciation is allowed. So profit is not to be reduced further. WDV will be reduced. Same like presumptive. No set off of unabsorbed depre, even no losses can be set off. Not no other losses also, no PGBP loss also. You have to maintain sufficient record as per 92D, and even report of 92E is also to be furnished. That two sections are applicable. What is the process? If you want to go for safe harbor, assessee will file 3CEFC. This is the form number. Before furnishing return under 139 to opt for safe harbor. See, reference of 139 is there. It can be belated return also. Circumstances on option can be declared invalid. What if you have adopted the option, you are declaring 4%? Later on, income tax has a power to say that your option was wrongly given. And now we will start litigations. It should be, let's say, 8%, not 4%. When income tax can declare your option invalid, AO may declare the option of safe harbor invalid if assessee has availed the benefit by giving incorrect fact or concealed the fact. It was actually not a raw diamond. You have shown that this is raw diamond so that you can disclose 4% and no further litigation can happen. And now AO came to know that actually it is some mixed product. It is not a raw diamond. It is something processed diamond. You are not selling into notified zone. You are selling somewhere else. In all those cases, your safe harbor option will be declared invalid and normal litigations will start. If safe harbor is adopted, in India, there will be no litigation. On international forum, also no litigation. Whatever is the MAP process, mutual agreement process under 90 or 90, that is within DTAA, those process cannot be adopted. So now whatever will happen will be strictly between you and income tax authority. And international forum will not come into the picture. You don't have the option of international arbitration, in short. So that was all the amendments that is there in your syllabus over and above the amendments which we have discussed earlier. That was with regards to budget. This is with regards to all the notifications and circular, which was not there for May 25, but this is applicable from September 25 attempt and onwards. For January 26 also. Some 5 case laws are there which we need to understand. And that is given as a judicial pronouncement. That is the second PDF, which I have merged over here. The very first judgment, very interesting one. Let's say there is a company in which I am having the share capital 1000 shares at the rate of 10 rupees. Company is going into the losses. Company is doing some internal reconstruction, and that's why company told me that now onwards your capital is reduced. Face value will remain same, but the shares will be 500 only. Now see, there can be 2 to 3 kind of capital reduction. One, wherein they will give you the money and they will say that your capital is reduced. If money is given and capital is reduced that much, then actually it is a deemed dividend under section 222D. Here it is not happening that. Here what is happening is face value is remaining same, the number of share is getting reduced. Means I have to forgo certain number of shares. Then whether it is capital loss, because see, assessee says that this is extinguishment of rights. Earlier I was a owner of 1000 shares, now I am the owner of 500 shares. My rights are reduced. Extinguishment of rights. Shares are a capital asset. Extinguishment of right is a transfer. So as per 45 subsection 1, capital gain arised, and this is a clear-cut loss. I have purchased those 500 shares in total for 1 crore and now it is vanished. So 1 crore is the capital loss. Can there be a capital loss for this capital reduction? Yes. See, if money is received, you are taxing it as a deemed dividend. If shares are reduced without reducing the face value, the capital asset has gone. It is an extinguishment of right. And yes, capital loss will arise. Principal Commissioner of Income Tax and another versus Jupiter Capital Private Limited. Supreme Court judgment. Reduction of share capital by company without any change in the shareholding pattern or without the change in the face value constitute transfer, because in relation to certain shares assessee extinguish the rights, and hence capital loss arising on the reduction of share capital is admissible. It can be set off against different capital gain. Second judgment is Supreme Court in the case of DCIT versus Travel Designer India Private Limited. Now what is that? What is the time limit to issue the assessment notice under 143 subsection 2? It is 3 months from end of the year in which return of income is filed. Up to then, scrutiny notice can be sent. 143 subsection 2, notice for regular assessment. 3 months from end of the year in which return of income is filed. Now what if I have filed the return of income of the year 23-24 on, let's say, 31st July 2024. So basically the end of the year is 31st March 25, and from that within 3 months, that is 30th June 25, 143.2 should be issued for the financial year 23-24. Now what if the return which I have filed on 31st July 24 is declared defective under section 139 subsection 9, and as per the notice I have rectified my defect, but all this completed on 15th April 25. Then when return of income is filed? In the year 24-25 when original return was filed, or in the year 25-26 when the defect has been cured. So 3 month time period to be started from when? 31st March 25, the year in which original return was filed, or 31st March 26 from the end of the year in which defect is cured. Law says 139.9 is a mechanism to rectify the defect. It don't change the year in which your return of income is filed, and that's why the return of income is filed in the year 24-25. The due date will be 30th June 25. If return is defective and 139.9 is issued, assessee has corrected the defect, then time limit to issue 143.2 will be reckoned from the end of the financial year in which original return is filed. Here, the date of 139.9 is irrelevant, which was obvious. The third judgment is important one. Supreme Court in the case of Bank of Rajasthan Limited versus CIT. Now understand, for the bank, there is some necessity to purchase the bonds of different companies, government undertakings as per RBI guidelines to maintain many ratio. These bonds may be of 3 categories. One can be the stock in trade, which has to be purchase, sale, and profit is to be on temporary period. The another one is also like held as stock only. So for us, mainly it is stock in trade. And the second category is mainly held till maturity, H2M. That is a long-term investment. So one is basically short-term stock in trade. One is basically long-term investment. Let us discuss first about this held till maturity investment. Let's say the bond is related to a company whose record date is 30th June. The bank has purchased this debenture on 31st July. Bond value is 10 lakh, but bank has purchased it after the record date. So from whosoever the bond is purchased will not sell you for 10 lakh. He will sell you for 10 lakh plus this 1 month interest, because that interest is gone now for them. All the interest will be now onward received by the bank. So the seller will charge you 1 month interest. The bond will become interest price. This 1 month is called as broken period. This broken period interest, let's assume 50,000. So bank will purchase the bond for 10 lakh 50,000, 10 lakh for the bond, 50,000 as a interest expense. Question is this 50,000 allowed directly as a deduction under PGBP, or it is to be added in the cost of the bond? If like this bond is purchased wherein 10 lakh rupees is given plus 50,000 is also given for that broken period interest because you purchased after the record date. So that 50,000 interest is to be directly claimed as a deduction under PGBP, or it is to be added in the cost? Reply to this. If it is your long-term investment, if it is held till maturity, yes, capitalize. Now the cost will be 10 lakh 50,000. This 50,000 is not directly allowed as a deduction. But if the bonds are stock in trade, short-term investment, then this 10 lakh rupees will become the cost and 50,000 will be directly taken as a deduction in PGBP. That is what Supreme Court has said. Bank has to purchase and sell bonds as per RBI guideline. Some bonds are held as stock in trade. Some bonds are held till maturity. Interest paid for the broken period of the bond from the date of last interest till the date of purchase in relation to bond held as stock is allowed as a deduction, and broken period interest for the bond which are held till maturity will be capitalized. Broken period means simple, from the date of last interest till the date of purchase. Then one more judgment again of Supreme Court, PCIT versus Adityan Technologies Private Limited. What this company has done? Company has developed a software. It has tried to develop the software for some advertisement purpose. So that software will be used for the advertisement and all. But what happened is much expenditure is done on this software, but later on this software could not be operated, abandoned. It is stopped, it is abandoned, it is a wastage now. The query is, whatever expense is done on this software, is it to be capitalized or it is a revenue expense and you can directly take the deduction? See, if this software was in use, then though we would have capitalized this expense and taken depreciation under section 32. But now this software cannot be used, it is abandoned. Then whatever expense has been done to develop the software, is it a capital expense or a revenue expense? Because if capital expense, no direct deduction, even no depreciation because no asset is there. So there is a sunk cost. And if it is a revenue expense, 100% deduction allowed in the year in which this software is abandoned. Supreme Court thought that assessee has done an expense with regards to the business to generate a capital asset. But if that capital asset is not generated, you cannot harm the assessee by saying that you will get no deduction at all. So let us say this expense is a revenue expense and assessee can claim the deduction. The expense incurred by assessee toward development of the software for advertisement, which due to technological development had to be abandoned, can be claimed as a revenue expense because assessee will not get a long benefit out of this. One last point. Delhi High Court judgment. Johnson Matthey Public Limited Company versus CIT International Taxation. What happened is, there is a company who is into foreign and there are some Indian subsidiaries. Indian subsidiaries have taken a loan from bank or so. They needed some bank guarantee so that holding company or the associated company which is there outside India gave the guarantee to the bank that if Indian subsidiaries of mine will not pay you the amount, I will repay the same. And for paying this bank guarantee, this company which is into foreign country charges some guarantee charges, guarantee fees from Indian subsidiary. And what income tax department is saying that this guarantee fees are indirectly one kind of interest that is being charged. So taxation should be done as if it is interest. The rate of tax should be applicable as if it is interest. And this company says, no, it is not interest because I have not taken a loan. I have not given a loan. I have given a guarantee. And what I am charging is a guarantee fee. We are not lender or borrower. We are a guarantor and guarantee. And hence this is not an interest. The taxability should not be there as per interest element. It should be as per guarantee fees. Then tell me whether these guarantee fees are actually a normal guarantee fee or is it an interest. Delhi High Court said that, see, this party has not borrowed, not lended. This party has given the guarantee and against that the charges are being received. It is not an interest. It is guarantee fees only. See what has been written. Assessee has extended guarantee for the loan taken by Indian subsidiaries and in return getting guarantee charges. Whether these charges are to be termed as interest? Undoubtedly, assessee is a stranger to the privity of the loan transaction, in as much as the contract of loan is different from contract of guarantee. The service fee or other charges in respect of money borrowed or debt incurred, the definition of interest, cover this line. don't cover any guarantee commission. The expression interest is defined to mean amount payable in respect of money borrowed or debt incurred. Undisputedly, the appellant has not borrowed any money. The debt, if any, which could be said to have been incurred was clearly not owed to Indian subsidiaries also. Accordingly, High Court held that the guarantee fee would neither fall within the ambit of Article 12 of India versus UK DTAA nor interest definition as per Income Tax Act. This is not interest. It is basically guarantee charges. That is what said by Delhi High Court. So those 5 judgments were there, which is okay. Any judicial pronouncement are latest judgment and by default important in the exam. So this was all about your judicial pronouncement and this was all about your statutory update. So first, please study whatever is your syllabus of DT, IDT, etc. from the new module applicable for your attempt, not the old attempt. Your attempt September 25, January 26, then read from the new modules only. All the amendments which are covered by both the budget, we have discussed in the lectures. The amendment video is already uploaded on the YouTube also, and those are covered by your module also. This lecture which we saw today contains the amendment which are neither there in the old amendment video nor there in your ICI module. These are the separate notification came after publishing the ICI module and hence to be discussed separately. For any query, for any clarification, I am always there with you. My contact number is there with you. JKSC helpline number is also handled by me. You can contact me out of there also. On Instagram also you can connect with me. On LinkedIn also you can connect with me. There are so many ways through which you can connect with me. To any professor of JKSC, we all are there to help you. All the very best. Do your best. Thank you so much.